The biggest problem when it comes to trading is knowing where the market is going to go. It can be pretty complicated just trying to work out, because you've got a red candle, a green candle, the price is going up, then it reverts and goes back down, it hits your stop loss and then reverses, goes back up again. What I'm going to teach here is just basically what I do, what I've done over the last few years. So I started trading way back in like about 2010. I began first stepping into trading, not knowing what I was doing. By 2018, I've been completely like, that is the only thing that I do to get by. I'm not a millionaire, but it does make a living. So the first thing that we want to do to clean up this chart is going to be to change the candles from just normal candlesticks to Heikin Ashi. Now, this does mean that we're going to lose the actual real prices, because these are average prices. It's like a Japanese way of averaging out the price over the day, and it just looks so much cleaner. So now when it's all reds in a row, we know that the price is generally averaging downwards, and when it's green, that's times when price has been going up. And this very easy to see. It's very easy on the eye because we're not doing anything too technical. We just want to get the general trend. If you have a look at that on just normal candles, you can see it's kind of all over the place. You're not sure exactly where the price is going. Change that over to Heikin Ashi and it's pretty clear that you've got a clear upward trend and then reverses and comes back down. The next thing that you're going to want is going to be a line in the sand. Just a very simple basic line which is going to be drawn to show you what the average price is over a certain length of time. Now for me here, I'm using I think it's a 250 candle moving average. So this is this yellow line that you see here is the average of 250 candles. Why have I chosen that? Well, because 250 represents about half a year. So that is 2 quarters, 2 trading quarters. I'm using a 4-hourly chart. So on the 4-hourly chart, 250 is a real number with real meaning. If you use it on like a 2-second chart or, like a weekly chart, it's going to be irrelevant. So it's really dependent upon the time frame that you're using it. So this is the average over the last 2 quarters, the average price over the last 2 quarters. And you can see here quite clearly, when it does hit, it does cause a sort of resistance and then it will come back down. Once it breaks through, generally you're going to be in an upward trend. Just like when it breaks down below, you're going to be in a downtrend. So it's a very quick and easy line in the sand. So is this currently in an upwards trend or a downwards trend? As well as, let's be honest, it also gives you a very good target to hit as an average if you're looking to go short, or when it comes out, you might want to be looking here as it reverts back down to the average. This is called a mean reversion. So it reverts back to the mean average. And then from there, that gives you a really great place to buy in before it goes up on its nice long run. And while having that sort of line in the sand is good, how far the price moves away from that line can get a little confusing, particularly in a very exotic market where prices are going crazy and there's a lot of volatility. It's hard to say or sort of gauge, is it time to sell yet or should you buy? You really want something like some brackets, some sort of, if it stretches too far up or stretches too far down below, it's definitely time to get in or get out. And what I use for that on a sort of day-to-day, if I'm looking to buy in or get out of the market, is going to be placing orders based on Bollinger Bands. Now, Bollinger Bands, what you can see here, they're in the green. So you want to buy when it's down on the green on the bottom. And if you're looking to sell, or if you're thinking things have got a little bit too volatile, it's gone up too high and you're looking to sell, I'd want to be selling off when it's coming out the top, which is why I've marked mine as a red line on the top as a great place to sell. Bollinger Bands use something called standard deviation, which is basically a measure of the volatility. So over, let's say, the last 5 days, what the average price has gone up and down in that day is going to be, say the price goes up 5% over a day, right? So 5% would be the average. That would be the standard deviation. You'd expect the stock's going to go up or down 5% in a day. So if it's outside of that, then you know that the price is particularly volatile. And my Bollinger Bands here are set for 2 standard deviations, so 2 times more volatile than the average day. So if it's like twice as volatile, that's where you're going to want to get in or get out. The more that you use this stuff and understand it, the more straightforward it really is. And it is nothing more than quantitative analysis, which is a very posh word for saying common sense based on averages. The other thing which I always use to sort of gauge how high a particular bull run or how low a bear market has gone is going to be an envelope. Now the envelope I set a little bit different to the moving average that I had earlier on. So this was a 6-month moving average. So this other one is more like a 5-month moving average. That's set on a 200-day, because sometimes the price can get stuck on either one, and it just gives you, if you're looking to buy on that average, gives you a bit more flexibility as to where you're going to want to buy. As you can see in some of these places, it doesn't come all the way down. It'll just get so close and then move up again. So it does give you a little bit more of an option as to where it is that you want to buy. Maybe somewhere in between the two is sometimes a little bit easier. Right now you can see this one has just fallen below the main moving average. So it looks like this is Apple right now. It looks like it's probably going to move down, may come up and test the bottom side before moving down a little bit further. But if you look back at Apple through the years, you're going to see that it's not very volatile. It doesn't really come up to the high line of the envelope or the low. It sticks pretty close to that moving average because there's probably so many people trading it. Very rare does it come all the way up very high, which gives you a very clear indicator. If you're holding the stock, if you're holding Apple and it goes that high, it's probably a good time to sell, because it's going to come back down to the average. Again, that is called mean reversion. And in this case, if you did sell here, by the time it did come back down for you to buy back your shares, they're only going to be a little bit cheaper. Some stocks are much more fun to trade. Apple is pretty flat, staying pretty close to that average. This one here is Facebook, and Facebook has been certainly more volatile. You see a lot more movement up and down through the years, and the price on Facebook has been quite crazy. If you bought back here just a couple of years ago at 150, and now it's all the way up, well, it went near $800. You'd have made it quite a bit of money on that one. But if you look at some smaller stocks, this one is HubSpot. I mentioned this in a video not so long ago. Again, it does come up to the very top a lot more often, and even to the bottom as well. So if you can get in right at the bottom on some of these, that's obviously the best place to buy. But the best place to buy in all reality is going to be when it has gone low and it just breaks out above like a downward trend line, and then it breaks out above just at the same point as also breaking above that moving average line, the like 6-monthly moving average line. Then you're either going to buy it on that breakout, or maybe when it dipped down to get close to almost touch it. So it's not an exact science. This is one of the things that you need to remember, is you want to buy in gradually with maybe smaller orders, not just go for one big order, but buy smaller orders, because you're not always going to get the price that you want to get. So just as it breaks out, maybe buy a little. As it pulls back down, definitely buy some more, because then generally it's going to go up, and it may not come back down to the average until it is significantly more expensive. And then as you can see, as it does break back down, it does come back up. So if you did sell here, or maybe you're looking to put on a short position, as it comes back up and retest the bottom of that moving average line, the 6-month moving average line, it's then gonna go back down. So this is really the line which gives you the best opportunity to make a gain, purely because statistically, when you look back over the stock over many years, this is just the place where it's just a very high likelihood that you're right in the direction. And that's where it all comes down to. It's just about upping your odds to being right on when to buy in and when to go short on stocks. And that's it, guys. It does not need to be all that complicated. You can just trade very simply. I've been doing it for like 8 years now, just using these very, very simple indicators, nothing too complicated. This is all that you really need. That's it. Let me know what you guys think in the comments down below. See you again in the next video.